So hi everyone, I'm here with David Wylie, who's the owner and commercial director of Lending Metrics. And Lending Metrics are a credit risk and decisioning technology firm. So welcome, David. Thanks very much for joining me today.
Thank you. Hello.
So first off, I wanted to talk a little bit about the pandemic and the COVID pandemic. What have you seen the impact been on your business and your customers? It's been about, 9 months now. And it's just good to hear sort of what your experience has been.
Very interesting. By way of a little bit of context, I was working in the financial services industry around about the time of the financial crisis, and March of last year started to feel a little like deja vu, and the expectations for 2020 at that time were not great. Happily, as a business, we went on to actually have a record 2020. So for us personally, as a business, it was a very successful year against an absolutely awful backdrop for the rest of the world and for a lot of people and their lives personally. So I think what we've seen from our established customers is probably an underwhelming year, and there are a number of reasons for that. And when I say underwhelming, I think the desire for most of our customers is to grow and to increase the balance sheet and increase the loan book. And it's no secret that the demand for consumer credit through 2020 has been hit pretty hard. The numbers published by the Bank of England have shown a near 7% reduction in consumer credit numbers during 2020. Customers, I think in November alone, about $1.5 billion of consumer credit was repaid, about 60% of that credit cards and the rest being personal loans. So now that's a bit of a double-edged sword for lenders, because on the one hand their collections are through the roof, too good, they might argue, but the business it's essentially wants to grow. So it's been a tale of two stories for us, really. Customers onboarding, excellent, record year. Established customers, I think, waiting with bated breath for the real end to the current uncertainty, hopefully brought about by the vaccine.
And what's your feeling around what's going to happen? I suppose we've now got vaccines that are gradually being rolled out around the world. I mean, is it sort of like a lightening sort of scenario where it looks like it's going to improve? And how do you think lenders will react to that? Do you think there's sort of pent up demand for trying to expand their loan books and sort of trying to get lending sort of going again, or is it there's still very much a wait and see kind of mode?
No, I think the expectation is very much huge pent up demand. Yeah, lenders gearing up to deal with that demand. A number of that's clearly the impression we get from our existing customers, but from new customers that have onboarded with us in the second half of 2020, that is absolutely their motivation. They see a significant opportunity where credit will rebound, probably in the mid to later part of the year.
From a decisioning point of view, one of the problems that's happened is a lot of decisioning and lending is made off historical data. So, for example, various amounts of bureau data or historical performance data. In a lot of places, that's been sort of the data's been changed fundamentally by the fact that we've had payment support holidays here in the UK, but I mean it's the same elsewhere around the world as well. And it's fundamentally changed some of that historical data. So how are lenders sort of thinking about that in terms of, because some of the models and the techniques that we used before aren't necessarily going to be as applicable going forward, and they've got to think about it in a new way. What's the risk approach you're kind of hearing about that, or have we gone far enough to really sort of see the impact of this sort of flowing through their data?
The benchmark for credit scores clearly have been recalibrated as a result of what's occurred, and that is a continual work in progress. One of the features of our core technology platform, ADP, is that it allows for ongoing and frequent modifications by the lender, and that sort of technology is going to come into its own in scenarios such as this. Additionally, however, we have seen a significant increase in demand for open banking data, which, in our view, is a more timely supply of data. It's more relevant and more up to date than a credit file will be, and is illustrating the current affordability and the current potential creditworthiness of that customer. In conjunction with traditional credit data, I think that offers lenders a more up-to-date picture of what are rapidly changing circumstances for consumers within the pandemic.
And so you're seeing like the investments from a technology point of view in terms of like trying to incorporate some of this data, that's what's sort of driving some of the market. I mean, because I know you've got quite a flexible sort of decisioning system and sort of and clients being able to do that. Is that sort of been what customers have been looking for, or is that a trend that's sort of building up, this sort of mass sort of ability to be able to customize things themselves and respond?
I think it's always been the case that lenders have wanted the ability to have very flexible and malleable technology when it comes to updating and modifying and testing their credit policies. But in financial circumstances such as this, that I think has been amplified considerably, and the need for that analysis, the need for that adaptation to new calibrated credit scores, and to deal with the rapidly emerging new sources of whether it be ID and fraud solutions or open banking data, and all of the other derivatives of those key requirements that lenders have to assess a customer, both from a credit risk and affordability, and from an ID and fraud perspective. They're changing rapidly. Technology is driving those, and I think the pandemic has accelerated that rate of change.
Yeah. Question is, I suppose, just whether it'll ever go back to what it was. And you just, I mean, is this? I mean, a lot of the phrases used, new normal, which everyone seems to dislike using. But is this what it's going to be going forward? I mean, we've got to get ready for it. I'm not sure if I can see it going back to the way it was.
I'm a traditionalist in that regard. I like the face-to-face interaction with work colleagues and with partners and people in general. So I hope, the romantic in me hopes that we'll return to near normal. That being said, there are huge efficiencies that have been delivered through these new technological solutions, and I think those will be very difficult for businesses to simply give up. Staff is probably the biggest expense of any business, and automation, if it's working well for the business, can drive huge efficiencies.
I mean, as case in point, and we're chatting to each other from the other side of the world, and it's I mean, you really can sort of, from a human point of view, I mean, it's so easy to be able to contact people and sort of talk to people pretty much anywhere, and you can work anywhere as well. So, which I think has been fundamental. But I suppose there's also talking a little bit around the technology side, and this sort of like mass customization and max flexibility, incorporating new data sources, those kind of things, and just whether that will ever come back out again, just to use sort of simple sort of regression scorecards and sort of, just with, just credit bureau. And it feels like those days have almost like gone in some ways, and just the new technology that's coming in, that's going to be mass customization is probably here to stay, I would think.
I think it is. I think the actual efficiencies that it delivers, as I said a moment ago, that it'll be impossible for businesses to give that up. And Those features that you mentioned, such as regression scorecards, they are still very much a feature of what lenders do. It's just that with the technology that's available now, they can learn more rapidly and they can then adapt more rapidly. I'll give you an example. So one of the features of our platform is that lenders can run, say, 5 decisions, a single applicant simultaneously, and run a live retro. So they're learning at 5 times the pace that they would have more traditionally learned by running a loan book for a period of time and then carrying out a retro analysis with the benefit of a retro from a credit reference agency. That's not necessary to do anymore. So the speed of adaptation can mirror that speed of learning, which means that the efficiency of the decisioning piece, as I say, affordability, fraud, ID, and credit risk, all of that can be adapted much more quickly. But I think it still will rely on many of the fundamentals that drive credit risk.
And I suppose the concern I have, is part, if you don't have that data, if you don't adapt to have this new data, is you get into this scenario where if you're just using the way things always were, you're either leaving restrictive in terms of cut-off scores, you're leaving money on the table, or you open the book up and don't understand the nuance of what it is, in which case you're going to see the losses coming through from a later point of view. And I suppose it's just trying to find that nuance, and it's almost like the portfolio is cut in a different way, or the application is cut in a different way. One of the features that we chatted about before was and trends that I've been seeing has been around sort of client customization, and being able to have clients being able to sort of customize and being able to adapt the software and sort of be much more in control. And we've seen that in the consumer space. One of the trends I've sort of seen over the last 6 months is definitely software as a service, and the ability for clients to be able to customize almost like their own journey without sort of using massive implementation programs has definitely been a theme that's come through. I know you guys have been part of that, and it'd be good to sort of just hear a little bit about what the experience has been and what the client experience has been around sort of seeing that and how it's sort of being adopted, or get your view on it.
So I would say in this past year alone, we have integrated with more partners than ever before. So a couple of examples of that. We take loan management platforms. Traditionally, the loan management software platforms have aimed to deliver an end-to-end solution, right from origination through to collections. The customer is now demanding best in breed, really. So one example, as I just mentioned, was loan management. Another has been banking platforms. So you're seeing a trend now whereby the loan management, the workflow and the accounting side of that loan management function is now contained within just the loan management portion of the solution, and the customers are demanding collections modules, originations modules, credit risk modules, payments modules. So yes, there is definitely an ecosystem and a demand by the customer, the lender, to bring these component parts together. So we all have to be openly connected. We need to be willing to deliver, able and willing to deliver to the customer in partnership with one another rather than in competition with one another.
And how do you think that's going to play out in terms of management? Because obviously you're going to have multiple vendors, all of which have got best of breed. Whereas before you would have just had one system that would have sort of managed everything end to end, albeit maybe not with some of the same feature set. I mean, every single one has to integrate. Every single one has to have account management, has to be managed from a service level point of view. What's the best approach to think about that?
That's a really challenging question, because we have been engaged with parties who have actually attempted both routes. Some have attempted to orchestrate the entire contractual arrangements through one mechanism, which has been a challenge because there are sometimes 4, 5, 6 vendors involved in that, so that can be a challenge, and it remains ongoing. And then there have been some other partners who have made it very clear that everyone engages with the customer individually, and that's something which the customer has to manage. But the plus the plus points for the lender are better technology, better designed and more appropriate for each individual requirement, rather than a one size fits all, more compromise. Compromise, correct. But also, I think cost. I think SaaS solutions, in comparison to these mammoth platforms, which I think have probably largely had their day, those combined SaaS solutions are considerably more cost effective in our view, and therefore the benefits to the lender are considerable. So it's probably a price worth paying.
Yeah, I mean, it does seem, particularly since the pandemic, that, I mean, SaaS in particular, I mean, the speed of setup and speed of implementation is sort of definitely accelerated it in terms of uptake, because it's been a solution to really, it's been a burning platform, which we have to get stuff up and running sort of immediately, and the infrastructure is sort of there to a certain extent, and it's very, very quick. I mean, so it feels that's a trend. But I mean, of the two, though, I mean, definitely there's a lot of partnerships that are out there, which is sort of like, people are starting to partner with different companies, so they have that close relationship versus sort of that direct model. Which do you think works better from your point of view? I suppose you're fairly agnostic, but is there a preference, or?
We have seen a considerable breakthrough in the Lending Metrics brand throughout 2020, and that has resulted in a lot of partners approaching us wanting the Lending Metrics technology, ADP specifically, embedded within their solution. So we're in favour of that.
Yeah. So I suppose if you build the brand, then you can sort of go direct, and that's probably a better thing from a company point of view, because you've got the visibility and you've got the direct conversation with the customer.
The vast majority of our customers are people that we deal with directly. That remains the case, but it's fair to say that the volume of partner driven, whether that be credit risk consultants or loan management platform providers or banking platform providers, that has certainly started to move the needle.
I know you've had quite a lot of success over the last 10 years, sort of a lot of growth, and awards for innovation. It'd be good to just ask, I mean, what do you think sort of driven that success from your point of view? And what's the philosophy that you've had in terms of building Lending Metrics, really?
We came into a marketplace where lenders' expectations were relatively low. They were expecting very high price tags, average quality technology, and very long lead times for implementation. And we sought to address those, and we sought to be disruptive, and we have been. And I think we've also gone above and beyond to accommodate those expectations of customers which are beyond the scope of the contract. In other words, we've just had a can-do approach. We want to get our customers into a place where they are happy with and using the technology, because it speaks for itself. So in just getting over those day-to-day hurdles by let's just resolve this. Let's get this out of the way, because once you're using the technology, that's where we've put all of our investment.
What do you think the future holds for decisioning technology? I mean, obviously, we talked a little bit about acquisition, I think in previous conversations around sort of the back-end collections piece, and we talked a bit about customization. But what do you think the future holds? I mean, where are we going in terms of decisioning technology, and particularly around the on the credit side and the lending side?
So there are lots of different emerging individual solutions to individual problems, and you heard me mentioned earlier ID verification is one example of that. So this ability to get a camera and a piece of ID and get yourself verified. That's relatively new and it's innovative, and open banking is of a similar vein. And it's important for us to be, we believe, the orchestration tool for all of that. Lenders see things that are applicable to their business today, but we need to ensure that we are openly connected to all of the new solutions that are coming along tomorrow, because we have every expectation that some of our customers will want to use some of them, and we want that to be consumed through ADP. So for us, it is about the credit risk fundamentals and speed of change, updating credit policy quickly, but it's also about being able to adapt to the new technologies that are going to become available to lenders almost monthly at the moment. There seems to be a new provider of something or other.
It does feel like the explosion of data and being able to add data and the flexibility to be able to then interpret that data. It feels like we've had a wave, and you talked a bit about open banking coming through, different type of fraud checking, but there's also like other data elements that are out there as well, which has always been there, but it's like how much of those are gradually going to get incorporated into decisioning. And so I'm sort of taking away it's really a little bit around flexibility, and your view is really around how do you build a platform that's flexible to be able to adopt some of that.
100%, yes. It's about being prepared for the next thing that comes along. I mean, to give you another case in point, an area that we're working on quite intensely at the moment is the gambling sector. As you may be aware, there's a huge amount of regulatory change on the way there, and there are a number of individual solutions which are largely aimed at addressing individual regulatory requirements that are anticipated from the Gambling Commission. But my experience through the adoption of regulation by the FCA was that those changes were just the beginning, and that story just carried on for years thereafter. If you look at payday lending as a case in point, payday lending, that journey of regulatory change began, and then ultimately many payday lenders were regulated out of existence. But that it didn't stop with the initial wave of regulation. And so as more and more regulation came along, more and more solutions and speed of adoption and adaptation to those new solutions was necessary. And so if you take gambling now, they're probably at the beginning of their regulatory journey. And this first wave will be just that, the first wave. And I believe they'll see many more thereafter. And they need to be able to orchestrate the various elements of solution through those various waves.
I mean, the regulatory journey is quite interesting, because I think there's a bit of a linkage between, we have a lot of this new technology because we've got the cost of data storage has come down significantly. The cost of data processing has come down significantly, I mean massively, and it allows all of these solutions to be built relatively cheaply compared to where they were sort of 20, 30 years ago. And so we've got this explosion of technology that's going out. But with all this data also comes the ability to be able to evidence your compliance as well. And it's almost like the regulators are seeing this as well, and there's almost like this competition between the two in terms of like how do you evidence it, then how do you regulate it, how do you evidence it, how do you regulate it, and it's quite, I find that quite interesting. It's there's definitely a linkage there actually. So I think I don't think it's going to go away.
No. To that point, the outcome of every single rule and piece of logic within ADP is supported by an audit, a full audit, not just what was the answer, but how was that answer arrived at. And so the prospect of having an audit, a regulatory audit, the amount of information that can be presented to the regulator is, incredible.
Yeah, but you're doing it by paper. You just think about how painful that would have been. And COVID. I mean, do you think that's, we're at the start, and certainly I spend more time on the collection space. And delinquencies have actually been down because of the support measures that have been put in place, which is quite different from 2008. But as we come out of this, and there's a lot of debate around when we think that's going to start to rise again, but let's say it's sometime this year, do you think the regulator is going to react to that as well and then put in even more regulation? So we talked a bit about payday loans, but I mean, we're going to have some sort of reaction to the COVID, and some people are in real financial difficulty. And does that lead to more regulation?
I hope not. I think lenders have been. If you think about the measures that consumer credit lenders and mortgage lenders have been required to deliver to customers in hardship over this past year, that's been a significant cost and a significant drain to them, and it was the right thing to do. I think aside from the specific political criticisms of the handling of the pandemic, I think the Chancellor has made some stunning moves, and those were the right moves, and that's meant that a lot more people will come out of this unscathed than would otherwise have been the case. So the prospect of yet more burdens being placed on lenders at the other end
concerns you.
I wouldn't be in favour of that. I think they've done the heavy lifting already.
It's been very interesting watching certainly the financial services industry. I mean, a lot of industries as well. I mean, the amount of emphasis that's been put on vulnerable customers, financial difficulty, and really since 2008, and a lot of that has actually worked quite well. Actually, I do kind of agree in terms of like being kind of ready for some of these things with processes in place, which has been. It's been interesting. It's been interesting to watch, and it's been positive, I think, in many cases. Now, obviously, you work in different markets as well, and you're not just in the UK. You've got an international arm as well. I mean, have you seen it sort of different between the different markets? Are you finding the same kind of themes everywhere, or is it are there subtle differences?
So at the moment, yes, we operate just in the UK and Australia, although we do have some quite exciting plans for further international expansion, and I'll make sure you're the first to know when we're in a position to announce that. As far as Australia is concerned, as you may well know, here in Australia we have a paradise as far as COVID is concerned compared with the UK. I'm here in Western Australia, and there is a zero tolerance to international travel without quarantine, and as a result, we have no COVID whatsoever here. Any cases are in quarantine. So the economy in Australia it is not really being affected so much, in my experience, by COVID. There are other things going on in the economy, such as the country's relationship with China, for example, which is not great, and Australia relies very heavily on its trade with China. So it's difficult to know the degree to which that will impact the economy. The most interesting thing about Australia is that in the last 3 years, they adopted comprehensive credit reporting for the first time. Something we take for granted in the UK and is taken for granted in other, such as the US, is that full comprehensive credit file of positive and negative information. That was unheard of in Australia up until about 3 years ago, where the only information available was negative data. CCJs and defaults and such. That is starting to open some doors. It's opening up the lenders to the possibilities of how they can improve their credit decisioning. So that's very encouraging for us. And actually, just last year, they also launched several open banking providers too. Whereas it was previously the screen scraping model of Yodlee and such like. It's now pure open banking, and that is again just another quite interesting comparison with say the UK. Open banking was spearheaded in the UK. However, the use of bank data has been far more established in Australia than in the UK because of this dependence on screen scraping of bank data and regulatory requirements for bank statement data to be a part of the underwriting process. So actually the adoption of open banking and all of the technological advances that brings in terms of consistency and reliability and security, those are all great innovations, but actually the market really loves banking data.
So like the case was already sold. So people are already sold on it. It was just the dynamics of how it actually works. So it'd probably be an easier adoption in Australia than it was in UK, because it struggled. I do think it struggled a little bit in terms of uptake, particularly at the back end. I mean, I think the acquisition in the UK seemed like that was the much greater uptake there. But the back end collections, I think actually the COVID piece has actually probably helped in terms of adopting some of that. But it's interesting for Australia though. So it sounds like I mean that sale has already been made, so the adoption will be there. It's just around getting the technology right on the front end.
Indeed. Consumers are just used to providing their logging into their bank account and providing that information. It's expected.
Okay. So what do you think is going to happen for the rest of the year in terms of like the development and sort of expansion, or I mean, what does the future hold?
For lending metrics, well, we do spend a considerable sum of our revenue on R&D, and we do have some quite exciting innovations coming in this first quarter. Again, I'll make sure you're the first to know when I'm in a position to reveal them, but they're all aimed around giving more control, ever more control to the lender, whether that be modifying their decisioning, whether it be analysing their data, onboarding third parties, all of those types of features. We want to put more and more and more in their hands and distill down its SaaS credentials ever more. Internationally, yes, we certainly do want to expand further internationally, but I think the main expectation really for this year is probably a very, very big bounce back in terms of customer activity, so lender activity, which affects all of our platforms, volume and therefore revenue, and we see the trend of more lenders onboarding continuing because the train is running full steam ahead at the moment.
I can see there's almost like put 2020 to one side. We got through the year, even if it doesn't change, and even if we're in this for a while, I mean, like we've got to carry on. And it feels like that's the pent up demand, which is no matter what happens, I think this stuff has to happen, right? So I think we see quite a lot more activity. I kind of agree.
Well, holidays is a biggie. It's probably the biggest. Clothes shopping. How many people are desperate to go out and do a bit of clothes shopping? I noticed that the numbers for home improvements and DIY, that's all been decimated too. And I think everyone's going to double down and make up for their lost Christmas this year by having a huge Christmas next year. So yes, a huge amount of pent up demand, and point of sale credit's going to be a biggie, I think, and and even some specialist providers. Holiday finance, I think, is one area that's certainly showing a huge amount of interest. So yeah, across the board, niche providers of discretionary spending.
Yeah, and it's just, I mean, we all need to have clothes. We still, whether we need to have a holiday, but we feel like we need to have a holiday. And so the demand's still there. It's just does it happen via a slightly different channel? So those providers that maybe can do things online, maybe can do things in a slightly different way, or can click and collect or whatever it is. I mean, the demand's still there. I mean, the business hasn't gone away. It's just the channel and being able to access it. It's just, and I think we'll start to see, do we all start to adapt, just like we have with SaaS, SaaS services as an example for on the system side. It's a way of we're adapting to almost like a new environment a little bit.
Yes. I think to sort of amplify that rebound effect, there are a couple of other things that I think need to be taken into account other than the lockdown as a result of COVID. The general stock availability is not there. So if you take a look at the availability of goods, there's a huge amount of there's a hiatus basically in the supply chain, whether that's driven by impacts in China or whether that's international shipping. We mustn't forget that tens of thousands of flights have not happened. So there's a huge strain being placed on the shipping supplies around the world, and the cost of freight has gone through the roof, and therefore people actually being able to get their hands on those goods, that's been impacted. And I think the second thing that we mustn't forget is, of course, the uncertainty, at least, around trade deal for Brexit. That's now done. Love it or hate it, and there will be plenty on either side of that argument. It's done. The trade deal is done. The uncertainty, at least, has gone, and so that gives business, if nothing else, more certainty to go into 2021. So vaccine, probably the end of lockdowns once that vaccine is fully deployed. International travel combined with international supply of goods and Brexit out of the way, and all of that pent up demand.
It's a new environment we've all got to adapt
yourself
to.
in and get ready for 2021.
Exactly. Yeah. Exactly. Well, David, thank you very much. I really appreciate making the time to chat to me. I really do. It's been great, and really interesting to hear your ideas, particularly around flexibility in systems, being able to adapt to almost like this new normal, I suppose, in terms of like incorporating data and like the customization for clients as well. I think that piece is particularly interesting because that really does feel like it's a theme, and it's been sort of developing over the last, probably much longer, but certainly I've seen it over the last 6-9 months. So really appreciate the time. Thank you very much, and hopefully we'll chat again soon.
It's my pleasure. Thank you. Thanks, Chris.
Thanks.